Welcome to the fifth and final module of this e-learning series on financial modeling for public-private partnerships brought to you by the World Bank and DFID. In this module, we will be focusing on applying sensitivity analysis to financial models for public-private partnerships. In the previous module, we focused on evaluating financial models. It is important to remind you that this mode of teaching is a participatory one. That means that you will be drawing on the knowledge and experience of other learners such as yourself. Let's begin this module by looking at some sensitivity analysis techniques.
First, I want to give you some more tools and techniques that you can use with Microsoft Excel. This is where it sort of gets fun. Now that you know the basics of modeling, you can use the functions of Microsoft Excel to do things like sensitivity analysis and even coming up with graphing for your results. That's kind of fun. We want to talk about sensitivity analysis, but I also want to give you some standards and some things to look for as you review financial models that are prepared for you. What are some common characteristics? So I want to talk about techniques and overall standards of practice for designing financial models, labeling, formatting, things like that, as well as using financial models to test out risks and support decision making. So what are key characteristics of financial models? Well, now that you've had some experience reviewing some different ones, as well as programming some of your own, here's some things that are very important in any financial model. Number one, it should be based on the needs of relevant stakeholders. So this is where we say that the most difficult challenge in managing PPPs, as you have said, is managing the different stakeholders. Well, if you're going to do a financial model, it should provide relevant information to stakeholders. For example, some of you are working on a marketplace project, right? Assuming the investment costs of a new marketplace and its operating costs, here is the total revenue requirement for the marketplace. If you're a shop, if you're a vendor, somebody who would be renting space in that market, do you care what the total revenue requirement is? Is that really relevant to you? What is it that you want to know?
The rent.
I want to know what the rent would be for my stall. Yeah, what would it be per square meter if it's small or large? So here's where I say that you have to identify all the stakeholders. And as we've seen in some projects, we can't simply say, well, the private sector, that's one stakeholder. Instead, you have to differentiate between maybe an equity investor as well as a lender. We've seen that they have different requirements. Models need to be robust. Robustness in this sense means must be able to deliver clear, definitive, and meaningful results to stakeholders that they can take actions on, such as, is the rent affordable? Right? Not just sort of, well, here's the total revenue requirement. And here's what I would often say is that unless, in my experience, unless you require your consultant or modeler to say you need to show us the rent for each category of tenant or vendor, they're oftentimes going to say, well, I've just given you a total revenue requirement. Here's the investment, here's the revenue requirement. My model has done the job. Well, no, you've got to say that it should be robust. It should be clear and easy to understand. This is where I oftentimes see models fall short. And I will tell you, now that you've done reviewing of models and some of your own programming as well, some modelers can make their models difficult to understand on purpose. Doesn't mean they're wrong, but it means that maybe they pack all kinds of assumptions into the formula itself without disclosing what the assumptions are. And again, it doesn't mean the calculations are wrong or the results are wrong. It's just difficult for you to see, you know, are they showing here's the assumed discount rate, or have they just plugged, I don't know, say 12% into a formula that you have to then go and unpack, as it were. They should be flexible. Must be able to readily handle changes in key input variables and assumptions about the project structure. And if it is well labeled, it should be easy to audit and double check. Everybody who does models is human. As humans, we make mistakes. I've had people point out mistakes in my own models. Have we encountered any potential mistakes in other people's models? Maybe? Maybe? Okay. So this is why it is important that I would say that modeling works best when it's sort of a team exercise. I think it's part of the reason that you may find that you get better results when you're working with 2 or 3 partners on a model rather than just yourself. And it really helps when they can catch errors as well. You should have a team of people who understand how it's done. It shouldn't just be, as I say, an individual's magic black box where you say that really we don't know how it works, but if we put this input and this input, we get this output. But I can't really tell you how it works. I'm just having faith that, I don't know, our modeler knows what they're doing. A list of the common stakeholders and what they really need to know from models. Well, consumers as a stakeholder group need to know things like, are the end user fees, whether they are tolls on a toll road or bridge, or fares on a transit system, or tariffs for any service, if they are affordable. And here's where I'd say things like, if it's a marketplace, we'll want to know what is the rent going to be, whether it's weekly, monthly, daily, or annually. And in some cases, you're also going to want to do affordability analysis. There are some services, maybe water or electricity, or solid waste, or others where you want to say an important benchmark is what is that as a % of average household income. There are some international guidelines that will talk about that things like water or electricity should be no more than a certain percentage of average household income. So compared to that. Governments, contracting authorities are going to want to know, well, what is the affordability of any availability payments or any partial guarantees? And is it affordable? We saw yesterday in the case of the vehicle inspection station that the city of Podunk guaranteed revenue equal to, I think it was 200,000 cars for phase 1. But you're going to want to know, is that affordable? Is there space in the budget to cover that? By the way, a separate topic that we have here and that the Tanzania PPP support program is also working on is how do you value the difference between what we call a fiscal commitment. A fiscal commitment would be like a availability payment to a PPP, which we know the timing and the amount. We've got a contract that basically says if you provide the facility, we will pay you this amount for the next 15 or 20 years. That's a fiscal commitment. And that one you can pretty easily predict how much it is and when it's going to be. But how about a minimum traffic guarantee or a minimum revenue guarantee, like we saw in the example of the vehicle inspection station? We said we would guarantee a minimum revenue equal to 200,000 cars a year, right? Do we know, can we predict ahead of time if we're going to actually have to pay that out or not? What if the actual level of cars is 180,000? That would mean that we would have to pay out. We call that one a contingent liability. And what is different about a contingent liability is it's difficult to predict the amount and maybe even the timing. But from a Ministry of Finance standpoint, that creates some interesting challenges of how do we value and how do we predict how much a contingent liability will cost us. And there are some ministries of finance that will say, well, because of all of that uncertainty, we're trying to manage budgets here, and we've got something, a contingent liability that's kind of jumping around on our projections. From year to year, we don't know how much it's going to be or if we're going to have to pay out or not. As a policy, we would rather support upfront contributions that are fixed, meaning we'll give you viability gap funding and that's it, because a contingent liability creates all kinds of problems for us in managing public finances. Okay, lenders, as we've seen, lenders will care about things like especially interest rates, overall riskiness of the project, the debt service coverage ratio. As I'd mentioned here, you understand the debt service coverage ratio, but it is going to vary from project to project, sector to sector. Higher risk projects or sectors or technologies are going to require higher minimum debt service coverage ratios. With investors, we've talked about the IRR. There are things like the IRR on equity. You also know the modified IRR, if you remember that one. A little more complicated, and then you may have other stakeholders that may want to know things like, there's no reason a financial model couldn't also include things like, can we show how many jobs we think will be created during the construction period and how many jobs will be needed during the operating period? You've seen this diagram before. The first time you saw it, it might have seemed a little complicated to you, but we said that every model starts out with a dashboard. And you've seen the dashboard. That's where you put all of your inputs and you get all of your results. It should be in one place. And we've said it should usually consist of a demand worksheet, or some worksheet that shows us what is the capacity of the project and what is the level of demand. Different projects will face different demand risks. But we want to know, does the project, it'll also affect things as we saw in our vehicle inspection station, like when should phase 2 happen? When do we need to provide the additional capacity for phase 2? Level of demand determines the capacity required, which determines the capital investment. How big of a facility are we going to need to build to meet that demand? And we said that the capital investment, that's oftentimes where you get a lot of input data, especially from your engineers and cost consultants, on all the individual line items that go into construction and startup. Next, we ask the question, okay, if this is the amount of the initial investment and startup, where are we going to get the money? Is it going to come from all equity or equity and debt? And if so, what assumptions should we make about term we sometimes call the gearing ratio, that's or the leverage ratio. What will be the ratio of debt to equity? How leveraged will the project be? And we have to make assumptions then about the term of the debt, the interest rate on the debt. From there, that feeds into our income statement. And you now know, or should be comfortable with, what's the difference between an income statement or profit and loss statement and a cash flow statement. You've seen both of those. Those are both flow concepts, where we start out with all of our revenue at top, whether it's the revenue booked in the case of a profit and loss, or the actual cash collected in the case of a cash flow statement. And then we subtract the various allowable expenses from income analysis or from financial analysis or cash flow. We didn't talk as much about a balance sheet. It's a little bit more advanced. You'll see them on financial models, but it requires a lot more sort of accounting knowledge and conventions to do that. One of the things that you'll see in a balance sheet is, do we have a buildup of sort of reserve funds? Meaning, as the project operates, do we find that we're actually building up cash and maybe keeping that in a reserve fund that can be used for things like renewing and replacing assets, or possibly it could fund a phase 2 expansion. And then we see some of the key results. There are many of them, but for end users or governments, are the revenues or the per unit costs, the tariffs, affordable? Debt service coverage ratio for lenders, IRR on the investment for equity investors. So you should be comfortable with all of the components up here. I want you to keep in mind that there is not just one financial model for a project, but you have different financial models for different phases in the life cycle of a project. So oftentimes, and we'll say that you can have a very simplified financial model at the PPP concept or pre-feasibility study phase. And at that phase, we're just using the available information. We haven't done a feasibility study or maybe a detailed demand study, but what we want to know is, we think the project will need to be about this big. We're using benchmark standards that maybe the O&M costs are going to be 30% of the CapEx. And what we want to know is, what do we think the revenue requirement's going to be, and is it affordable? We would say that at that stage, because we're just using rough benchmarks, we have a wide range of uncertainty in what our estimate of the affordability of the project is. So it would be here, like shown the first one in black. When we do a feasibility study, now we're getting out from behind our desk. We're actually hopefully doing demand surveys. We're now actually looking not at benchmark costs for the industry, but maybe specific costs for the project itself. And usually what you see is, as we saw it in the case of the toll bridge that John led us through, that we're going to add things like the cost of environmental risk mitigation. And usually what I find is that the cost estimate from the pre-feasibility study gets increased because we find out more things about the project, we come up with costs for risk mitigation, but because we have done a better job of gathering data, we've narrowed the uncertainty, meaning now we should be more confident in our cost estimate. It's unlike the pre-feasibility study. When you do tendering, we saw this in the case of the vehicle inspection station yesterday. If you have good competition and if you do allow for innovation from bidders because you allow them to choose the inputs, you'll find that at the tendering phase, oftentimes the price comes down. But here again, we'll say that the actual prices usually have certain formulas attached to them, such as for adjustments for the price of inflation, or there could be adjustments for some of the other input costs, but it is much narrower. And then even during the operational phase, well, you're going to need financial models at least to check the realism of each of your estimates at each phase. Just understand that they differ. We'll also point out that after this phase, we have what we call financial closure, right? That's when the lenders will say, okay, we'll look at the contract after it is signed. Then we as lenders are going to do our own due diligence on the project. And sometimes you'll see that, for example, at the concept phase, the first phase, the government is oftentimes coming up with annual estimates of revenues and costs. Pretty broad. By the time you get to the feasibility study phase, governments may say, no, we're actually going to do that on a monthly basis, so much more detailed. You'll find that even lenders who have a good deal of at risk, they may do their own analysis and come up with one that is actually done on a weekly basis. So throughout the 20-year term of the project, there's actually costs identified per week, much more level of detail. And again, as we pointed out, anytime what a financial model does in terms of gathering its inputs, sometimes it gets misunderstood that with what John calls maybe a false sense of precision, that when we show a number, like the revenue requirement or the expected tariff cost per unit of a project, that we can specify. We know exactly what it's going to be because we've got that number in our cell. And actually, the best way to think about it is, no, that's the average of a range. And at the beginning of a project, we're oftentimes more confident in what that range is or cost per unit. But over time, as we go forward in time, our ability to predict what that cost is going to be will deteriorate. There'll be more uncertainty as more risk factors take hold over time. This is also why, in practice, many PPP projects, long-term ones, actually have provisions for the fact that we anticipate that about every 5 years, both sides will come together and revisit the contract to update it and possibly to see, well, are there certain changes that we should make to improve the project overall? But there needs to be at least mechanisms and techniques for fairly adjusting prices during the term of a contract. That again, it's oftentimes difficult, unless it's just a single purpose project company, to have one price or one formula that takes hold and stays the same for 20 years. A lot can happen in 20 years. Let's see, you've seen all of the, this is, if you're interested in this is sort of a checklist of some of the common data that you'd need to gather when doing financial models. Here we've got the basic worksheets. You're all familiar with these by now. Here's a list, a common list, at least to get started, of if you're ever drafting or reviewing terms of reference for consultants and you're thinking about, okay, well, what information do we have them gather in terms of technical data? Here's a look at a common checklist that you can borrow from. You can look at this later on. I won't go through it line by line here. Data on the capital costs, breaking those down. Data on the operating costs. Now, an important thing that I think, good morning, Caroline, an important thing to include in your operating cost data, we've mentioned this before. Let me ask you a question here. Why is it important when we come up with our estimate of operating and maintenance costs? Why is it important to differentiate between fixed O&M costs and variable O&M costs?
Okay, this was it was our discussion here while we are preparing this financial model, and we find that there is a specific a cost maybe for those dealing with the utilities, maybe electricity, water supplies. It seems that these are the fixed, but there are some others which are we are saying that it can vary. Maybe it's depend upon the type of project. It can be an advertisement, something like that. So these are, we might take this as a variable.
Okay, but why is it important? I'll tell you, as a modeler, it's a heck of a lot easier to just have one line for O&M costs, right? And just say, here's total O&M costs. It's a lot more complicated to figure which percentage of costs and at what level will be fixed, meaning whether the project is operating at its full capacity or not, and which ones are variable, meaning they change as the occupancy or the use of the facility has increased. Why do we do that? It's a lot more work, but why is it necessary?
Yeah, it's necessary to determine the accurateness of the project made based on the variation of the
Sure.
project. Yeah.
Models are meant to be tested out and varied. One of the things that you might want to know is, say in the case of our vehicle inspection station, if the number of vehicles drops by 20%, is it fair to say, well, then all of the O&M costs drop by 20%, right? Setting up worksheets, here's where, again, I would say that I find that a number of modelers kind of fall short in practice, which is they don't label their work, but make sure, hopefully, that for any reader or reviewer like yourself, each worksheet has a clear title, what project we're talking about, maybe what scenario. It's not unusual that you will be looking at different scenarios for the same project. Do we do the small version of the project, the medium, the large, or other versions? And when you're looking at these models, you're going to want to know, well, wait a second, is this version 3 or 4? So label it well at the top. I would say also, leave a column blank, as I've tried to do in the model I shared with you, that you can show the source of the input assumption. Meaning, we saw, for example, I think it was in the marketplace one, where it sort of said it assumed, I don't know, 85% occupancy. It'd be very nice to know what was the source of that. Maybe was there a market or demand study done? Is there somewhere we could go and we could actually say, here's the methodology they came up with on willingness to pay and affordability and et cetera for coming up with that. That's sometimes the most useful information in a model. Where did you come up with it? If you don't have that, it's very simple to say, well, 85%, it's in the model. We don't know where it came from, but we have to work with it. You can use color consistently to show which are input cells that you can change, which are output cells that give you the results, and which are the cells that you should not touch, because if you do, you might risk interfering with the model itself. So I think I've showed you some of these. Again, I'm not saying that this is the best way to do it, but hopefully you might think that it is nice to label things well and clearly, have the project title, do things like show both the nominal year and the project year, show which are the cells that actually, this is a CapEx worksheet, which are the cells that originate from the input assumptions. Those are highlighted in yellow. The rest of them are calculations that stem from that. Even showing in here what are the formulas. I think I tried to show you that. Then you can really understand that when you say, well, where is he getting this 25 from? Oh, okay, it's line 7 here. Well, where is that? It's line 7 here plus line 15. So we see where it comes from. It takes more time for modelers to do this. And many of them will be sort of like, oh, you know, I don't do that. I'll just give you the results. You can check it yourself. But boy, you're adding more work to do this. And you can say, yes, that's why we hired you. I need to understand what it is you're doing. So go ahead and show your assumptions here. Here's, again, another look at a dashboard. You're familiar with this one that we worked on. Here's a different one that we looked at last week. It was a solid waste management recycling project and showing both input assumptions, what units they're in. Is this a percentage? Is this a number of tons? Is it a figure of, you know, what are the units, as well as what are the sources of these? Does it come from some other consultant's feasibility study, or maybe we find out that as we're working on projects, geez, we're using assumptions that were based on studies from 5 years ago. And unless it is shown here, it's very easy to just continue maybe using old data. But you might say, boy, we really ought to update that. Okay, I'll also just point out that you can use graphs, and today as part of our exercise, I'll show you some easy techniques for doing graphs. Here are different graphs. Here is an example. Yesterday we gave, we made the award. Well, what was our award criteria for yesterday's VIS project? How did we award it? What was our award criteria for our procurement decision yesterday?
Meeting performance standard at affordable price.
All right. So it was everybody who met the performance standards, and then it was the lowest price. And to make it fair, we did it on a present value basis because it changed over time. Here's another example of a water concession project where they did the same thing. All bidders said we'll meet the same output standards, we'll meet minimum output standards by a certain time, and the award was based on the proposed water tariffs for end users. And the graph sort of showed, well, here's how each bidder is told you propose your tariff for year 1, 2, 3, 3 to 5, 6 to 10, 11 to 15, etc. And they made the award decision based on that. But graphs can be a very good way of showing on one page how you are doing these things. I want to just give you some practical advice, at least with modeling. One of the key requirements of any PPPs, and the biggest challenge, is that they are financially or commercially viable. Meaning, especially, can our private partner finance the project and recover their costs from it? One of the dangers I sometimes see with financial models is when we focus too much on the financial model itself, we end up saying, well, the challenge is how do we make the financial model work? Because if we can make the model work, the project will work, right? And here's where I'd say one piece of advice is don't confuse the map with the territory. What does that mean? Anybody want to? Yes?
Let me try.
Yeah.
A map is a representation of something that is existing on the ground. So it's not a reality of what is existing, but just a sketch. And the territory has more things than what is seen in the map.
Very well put, yes. Keep in mind, the model is only a sketch of some of the measurable information on a project. And it's meant to aid you in decision making, but just because you can show on a map that something is possible, there's other things that will arise. Financial models give a range of likely results. You've heard me say this a number of times, so sometimes I think that when a modeler or consultant say, here is what the price of the project will be, or here's what the revenue requirement is. We know that I would say, maybe you're overconfident in your estimates. I would feel more comfortable if you say, here is about what we think it is. We think it could be maybe somewhere, it's likely to be between this level and this level. The expected average would be somewhere in between, because there's always going to be variables that we can't control for. Our assumptions can be, can be wrong. That's when we're being very realistic, that our assumptions they're just that, they are assumptions. Financial models are meant to support or inform decision making. Sometimes I see those that work too much on financial models sort of think, no, the object is, our goal is to get the financial model to work. And as I think John pointed out yesterday, that, well, if we make assumptions about we'll reduce the capital expenditure and we'll increase the traffic estimates and we'll, I don't know, maybe raise the tolls, we've got a workable project. And it might be that the model works, but that doesn't reflect what's actually possible in reality. And then here again, I will say in red, in the end, governments and private developers, they sign contracts that allocate risks and responsibility. They don't really sign financial models. Sometimes this changes a little bit, and in large and complex project financings, there are parties that will say, let's agree on a financial model. Let's even have an independent party audit our financial model to make sure that it's a fair representation. But I would say, well, really, in the end, you may have your own financial model that says, based on these projections, here's how I think the project will proceed. But we don't really just sign a financial model. It's not really realistic. Yes, working with advisors and consultants on PPPs, especially those doing financial feasibility of analysis. As we said, I expect many of you are going to be overseeing these consultants and advisors. Here's some practical advice I have for how to do this well. Number one, require the model should be clear, robust, and flexible, right? Clear and easy for you to understand, well labeled, they show their work, takes more time, but that's a requirement. Robust in that it gives meaningful results, very specific results so that you can determine is it affordable or not. Flexible so that you actually can make changes. It takes more, as you know, it takes more work for the modeler to make a model more flexible. You got to have more input variables. Some of you have asked questions about, like, how can I program in different possible terms for loans? What if I want to say, here's what it would be if the loan were 8 years, 10 years, 12 years. It takes more work to do that. But models are meant to be flexible. And again, oftentimes, if you don't require it, I've seen some modelers that will come up with a version of a model that they basically say, here it is, this is how the project will operate. And you may say, but how can I change different assumptions about it? How can I make changes? And their answer might be sort of like, well, you don't need to. We think it's going to be this way, easily done. So make sure it is flexible. Provide a list of the key stakeholders and the results you want the model to show. Meaningful results for. Sometimes you will know the stakeholders, the individual stakeholders, better than they will. And I've seen times that if you don't require them to show it, maybe for, we want to know the price for small shop owners, large shop owners, many different categories, they may not assume that on their own. They may not show it. Require the consultant to submit an outline of the model, including a diagram of its key components early on for your review, so that you understand. Maybe it's sort of like, what was it here? John here is an avid golf fan, and one time when I was showing this to a group of people, somebody said, it looks like the map of a golf course. Like you go from hole 1 and then you go to hole 2 and well, anyway, you're familiar enough to show what to this case now that you can say, here are the main components that we want to at least see. So before you actually program the model, what are the results you're going to show? What are the major worksheet components that we should expect to see in the model? Okay. Require clear formatting standards and labeling standards so that things like the units being shown, you know, is it a percent, is it a year, is it a dollar figure, is it shown in shillings, or is it shown in dollars, or whatever. I would say it's also good, you might get some pushback on this, require a 2-hour face-to-face meeting where they actually show you the model, they walk you through it. It's meant to be used and tested. They'll probably resist. They'll probably say, no, 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 that's what email's for. We'll just email the model to you and then say, do you have any questions? And you're having a tough time understanding it. And instead, if they're going to the trouble of designing this, design this for your project, they should walk you through, here's what it is, here's how we make changes to it, here's how you can use it, here are the variables you can change, here are the assumptions that we think you should not change and why. And then also, don't necessarily assume, sometimes again there's a false sense of precision. I know at one point I was asked to work on a waterfront development concession. It was basically a ferry terminal project. And the developer in this case wanted to have a 99-year lease on the land to build a ferry terminal. So they wanted me to do a project, a PPP project, a financial model for a project with a 99-year term. Does Microsoft have enough columns that you can go out 99 columns to the right? Can you do that? Is it possible? Could you do a model for a 99-year project? What is the answer? Who can tell me? Yes, you can do the model for it. There's enough space. You can keep going 99 columns out to the right. How confident are you in your projection of what the cost or the prices will be in 99 years? How confident are you? There's a number out there. You can make the assumption that prices will increase at this rate or these things, but in 99 years, there'll be a number out there. How confident are you in that number? You're shaking your head. Not very, right? You would say that, well, we're confident maybe in the first year or two that it's going to be within this range. As we go out 99 years, we're going to see a huge variability. We'll have a number out there, but that's going to be an expected average of an enormous range, right? So just want to say, don't necessarily assume that your advisor can magically predict things. A model is really just a collection of our best assumptions and our projections of how those assumptions change and relate over time. So again, understand that just because a modeler is showing something out 20 years into the future, don't necessarily think that we know exactly what that's going to be. That's the expected average over a very broad and increasing range over time. Okay, next, pull out your laptops. We're going to do some exercises. Who can tell me what is sensitivity analysis? We've mentioned this terms a couple of times before. What is sensitivity analysis? Who can tell me?
It's how one variable can change with the changes of another variable.
Yeah. We use a model as it's meant to be used flexibly, make a change to our input assumptions because they are that, assumptions, and we see how the rest of the project responds to it. So you did examples of this. It is asking, or it's answering the what if question. What if the level of revenue or the demand or traffic for the project drops by 10%? What are the results? What if the construction costs are 10% higher? Or what if the operating costs are more? Now there's a difference, as I'd mentioned, between sensitivity analysis and scenario analysis. Scenario analysis is saying that usually when risks or uncertainties occur, they don't have the courtesy in the real world of occurring just one at a time, right? It's not the case that everything is the same except revenue is dropped by 10%. It's usually the case that there's multiple risks or when things go bad, they don't just go bad one at a time. It's a whole range of things that go bad. That's how risk happens. So we might have a pessimistic risk scenario. What if a number of key variables are worse by 10%? Higher construction costs, lower revenues, higher operating costs, etc. What if there's the base case that holds, and then what would an optimistic scenario be? You can also look at scenarios, as we've seen, maybe by, here's a scenario of the project with viability gap funding or without viability gap funding. Or here's the scenario of the project on a small scale. We maybe want to look the project on a medium scale, meaning a larger project, more costs. This is again why we need to think about fixed and variable operating costs, and then maybe a large scale version of the project. Here is a graph of a type of sensitivity analysis. We said here was our urban transit project. It required a $50 million investment. We said here are the cash flows for each year. And then we we calculated the net present value at different discount rates. We said that if the discount rate were 0, the NPV would be positive $75 million, so right here. And I graphed it for you, and I said, okay, if the discount rate goes up to 5%, now the NPV drops to 41 million here. And at 10%, 15%, what do we call the discount rate when the NPV, the IRR, thank you, yes. One way to do this is a bit of a tedious way of you make one change to an input variable, you note down the output, you make another change, you note down the output, but it takes a lot of time to do this. There's a far more elegant way of doing it, which is using Microsoft's what if function. So a more elegant way to do this is to use Microsoft Excel's data table and sensitivity analysis functions. Here is the sequence. I'm going to guide you through it step by step, but you first go to your data tab. Under data, you pick data tools. Under that, you pick what if analysis, and then you create a data table. But let's walk through this step by step. So here's what I want you to do. I want you to open up this model that I showed you, I think, on Tuesday. It was a simplified one-page model on a municipal solid waste project. It was the one that we said just had a 10-year term, if you remember. So I want you to open up this on your laptops. Open up this file. It should have been sent out to you. I think it's called 5.1. Do you have that? Got it in front of you? Okay, good. So that was step one. Step two, off to the side, I want you to pick 2 blank columns, and I want you to label one of them revenues. That's going to be our input variable. The other one, label it IRR on equity. That's going to be our output variable. So we're going to do sensitivity analysis to say, if we make changes to the revenues, what is the resulting change in the IRR on equity? Understand? So this is going to be our data table here off to the right. Are you there? Do you have it in front of you? Let me know when you're ready. So you've labeled those 2 columns. Good. Oh, good.
Is
Oh.
this one? No,
Yes,
it's this one.
but you need to go to the model. That looks like you're on, are you on PowerPoint?
Yes.
Okay, so go to the model, the spreadsheet model. So you've got your 2 columns set up. We'll go to the next one. Step number 4. This is important. Under the revenue column, very important, leave the first row blank. See how this one is blank? Underneath that, so starting with the second cell underneath revenues, start out and fill in the range starting from 80 to 120. You probably know the shortcut to doing this. You just type in 80 and 82, you drag it down, and it will automatically fill out the rest. So this, we are telling in our data table, this is the range that we want you to compute IRRs for. That revenue will be range from 80 to 120. Okay, as a review question, what is our base case? What's our base case assumption on revenues? 2 columns, yes. But you have to label them. You have to label the first one revenue, the one next to it IRR on equity. Let's try 80, 82, 84, 86. Yep. Now the easiest way to do it is once you've got, yeah, there you go. Just drag it down. Yep. Make that first cell 80, not 82. There you go. Yep. And then just fill out the rest. You know the shortcut. Once you type in 80 and 82, you just drag it down and it will fill out the rest of your table. So we're going to move on to step 3. You ready? You with me? Step 3. In the first blank cell under IRR on equity, you see this cell here? Remember, you've got this cell under revenue, it's blank. Right under IRR on equity, I want you to type in the cell address. Just say, in my case, it says equals E25. That is our IRR on equity. Make sense? So just type in here equals that cell address. We're going to move on to the next step, step 4. Listen up. Starting with the blank cell under revenues, see that blank cell, that's that first blank cell under revenues? I want you to highlight and select this whole area, both columns going all the way down to the last row where you've got your ending revenue level at 120. Just highlight that, okay? Next, I want you to go and I hope it's the same. Do you see up here where there's a tab that says Data? Click on Data. You with me? All right, so the next step, step 5. Now that you've got the Data tab clicked, go to What If Analysis over here. You see that? It says What If Analysis. Underneath What If Analysis, you have a choice for Data Table. Click on Data Table. We're getting close here. Now, when you click on Data Table, you get a little window that shows up. It says Data Table. It says Row Input Cell, and then it says Column Input Cell. All you need to do is type in, and you should use the dollar signs, type in the cell address here for revenues. And in this case, that cell address is F12. Once you've got that cell address, click OK. I hope you see that this will save you a lot of time. And what you can also do is we say you can graph your results, which I did here. I actually chose a range of not 0 to 150, but 50 to 150. And from, what would that be, -5% to 35%. But you can see that as you change the revenues, going from 80 up to 120, here is how the IRR on equity changes. And I'll point out that you can do that for many different variables. So a common input variable is what if revenues change. Common output variable is IRR on equity. Let me ask you a question. See who knows the answer. Give me another example of an input variable and a different output variable that you might want to test. I gave you revenues and IRR on equity. What is another pair of input and output variables you might want to test? Charges, meaning in the case of this project, yeah. Ideally, what you're trying to find out here, which variables on the project are the results the most sensitive to? If you discover, as we've seen before, if you discover that, gosh, a drop on revenues of just 10% means that the project is not bankable. The DSCR is too low, or the IRR drops, or something like that. This is then when we may say, this risk is too important, the outputs are too sensitive to it. It's not a risk that a private partner could bear, because if we're just off by plus or minus 10%, project becomes unbankable, so we may then say, here is why we need availability payments, or we need to give a minimum revenue guarantee. Now that you're familiar with some of the techniques of sensitivity analysis, as well as making graphs for your PPP financial models, you can test your knowledge on this subject by taking the following short quiz that'll appear on your screen shortly. To each question, please answer either true or false. Congratulations on completing this quiz on PPP financial model sensitivity analysis and graphing.
I'm Johnson Makalanga from Temeke Municipality. I want to, in a nutshell, present to you on the project of Temeke Market Stereo. According to pre-feasibility study, Temeke Market is a kind of the project, a brownfield project. Will cost about 15 billion or 68.6 US dollars. So went through to see how we can do the review of the financial analysis done by our consultants. So because of the technology, you cannot see what we have just done. But basically, in order to come to the clarity of understanding, we have to consider a number of issues in financial analysis. For example, as we started, we wanted to establish what is the revenue sources from that developed market. That there are a number of stores, large and small, and there is other source of the fund from parking, truck, and all the like, including the advertisement, are available in our analysis. I could have shown you had it been, seen properly, but they are indicated. And again, in the revenue aspect, there is a consideration of acceleration rate, of which is 25 increase of the prices of the fees and the rent and the other like after 3 years. So in our revenue, basically, because the project is considered during the construction, the 2 years for construction, and on the 3rd year, it will start operation. So our revenue started from the 3rd year, goes up to the 15 year, which is the term of the project, though expected to expand maybe to 25 years or so. But basically, it is 15 years. And the ratio for the capital, it is 70 by 30. That, the land, the SPV, because the design of our project, SPP, is design, build, finance, operate, maintain, and transfer. So there is, the leverage is 70 to 30, of which, they take a loan of 7%, and the 30, it is the equity, the owner's money, which will be invested. That's what we went through. And it is promising because the net present value, it is possible, and the internal rate is reasonable. Then we have analyzed also the cost of operating, which are here, can be seen, and all other issues we considered. Then, as we shown such figures as analyzed here, we wanted to go through into organizing a mode of which you will be testing, because the occupancy, for example, it is 80%, but again, for the upper, because it is a G+2, we expect maybe the growth will be, the occupancy will be 50, and it can go up as we go along. But on the very start, occupancy. Yeah, 80% occupancy on the ground, on the because we expect to appetize other customers to increase more than what they are now. Therefore, but because it is G+2, we expect the upper floors, according to the assessment done, willing to pay your location or whatever, that it replicates according to our feasibility study. That would be shown. Now, as we in the sensitivity analysis, had it been reached there, we could have known if we change the price, for example, the revenue would just go up like that, and that were the parameters to be considered. Now, the presentation is not yet completed, but we know the capex, we know the revenue already, and the other, all the required information is. That could be all about of what we have so far done, but with time, because it takes time, we will present the entire modeling, and we could just show you very clearly, and even the graph on the nature of the project which is coming to being. Thank you for just brief presentation.
Does anybody else have questions?
Yeah, 15 years concession. Yeah, yeah. But expect to be maybe expanded to 25 years, but base is 15 years. And another thing I didn't mention, the loan period will be 8 years. 8 years, the payment, if they take a loan.
May I ask in this project, what is the primary source of revenue?
The primary source of revenue is user pays. User pays, yes. Yeah, well, the user pays, there is categories. There is daily fees at the market, but there are again rentals on the stores provided. But there are the businesses that they pay daily. Even the stores, they pay daily, there is a late. But again, at the end of the month, they pay rental fee. They are all stipulated, they are shown in our analysis.
Can I know what the financing structure of your project? The financing structure of the project, what the equity and what the debt, and also how have you planned to use that financial structure? Are you going to start in grace period? Are you going to start to use equity for construction? In which percent of the equity, or the in first year, or all that means all the amount of the equity you use in the first year, then you come to use for debt. How do you structure how to spend the capex?
Actually, it is stipulated the leverage, as I said before, it is 70 by 30. It means 30, it is equity, of which that the owner of the company will just pay that money. I would expect on the first year after financial closure, they will start using that money as, they are assured of getting the loan for the second year to finish up what is to be completed so that the operation starts.
One more question I have. Of the data that you've been able to collect, cost information about the investment costs or operating costs, which are you finding is the most difficult to collect or verify?
Yeah, the cost for construction is very more difficult, but the revenue are easier.
Okay.
Yeah.
Are the operating and maintenance cost estimates fairly reasonable? Do you have background data
Maybe
for
I now
that,
cannot just come to the final end. It's a mere feasibility study. When you go into details of feasibility study,
Sure.
you come to being, then you are.
Oh, absolutely. I just, as we've as we've pointed out, though, one of the things that I wanted you to do in this workshop is to look at a pre-feasibility study with a mind to saying, when a full feasibility study is done, here's what we would really like the consultants to focus on and verify. So if, in that case, which of the, I don't know, say the inputs for your financial model would be the most important that they verify, in your opinion?
Yeah, the important information, the user pays analysis which we've done are very important because I know the investor will be attracted because they are, appetized to see the revenue are inevitably collected at that level.
Project is Boko Dawasa, construction of Boko Dawasa bus terminal. The project will be located at Boko, Kinondoni Municipal, and the project sector will be transportation sector. The project owner is the Dar es Salaam City Council, and the total project estimates is 29 billion. And the duration of the construction will be 24 months, 2 years. There is financing of the project. The project will be having two sources of finance. There will be loan debt, which will be 70% of the total project cost, and the equity will be 30%. Also, there is interest on the loan, which is 16%. And project loan recovery will be 10 years. 10 years meaning 2 years grace period during the construction period and 8 years payment. Source of revenue from the project. Mainly there will be entry fees of the buses. We also have renting of shops and all that. Business people will be renting, so the fees will also be one of the source of the project revenue. There will be operating and maintenance cost, which will be electricity, salaries, dislodging, annual maintenance, periodic maintenance costs, and utilities. The total, there will also be VAT, will be 18%. We have tried to develop a model, but we're still working on it. It's not yet complete. Thank you.
Thank you. Does anybody have any questions? Again, a question that I have is of the data that you need to collect for your inputs, which do you think is the most difficult, at least, to come up with? Or which would you want a feasibility study to focus on? Where do you think most of the input analysis work needs to be done?
Okay. Actually, on the estimation of buses, especially on the revenue part, there's difficulty on that. Because currently, Dar es Salaam City Council, we have Ubungo bus terminal. And as everyone knows, right now it's complicated. There's construction going on nearby and all that. So there's difficulty in estimating the exact number of buses that will be entering the new Boko bus terminal.
May I ask as well, I'm ignorant on the subject, but are buses or daladalas currently paying to enter the existing terminals?
Yes.
They are paying?
Yeah.
Okay, that's important.
Would they need to pay more to use the new terminal than the existing one?
Yes, because the new one will be having new facilities and all that. It will be more improved. So I think the fees have to be adjusted from the existing one.
Okay, and just talking stakeholders, do you think they might, will there be any resistance to this?
There might be, but considering the current situation, obviously if the new bus terminal is fancy looking, more improved, people have to pay according to the standards of the new constructed one.
Right, but you'll use the model to examine the affordability
yes,
for the users, right?
Yeah, that's very important.
Balanced with what?
The affordability should balance with the service.
And we need to balance affordability with, begins with a B, anybody, affordability and bankability?
Oh, yeah, bankability.
Right?
Yes.
Okay. All right, very good.
Thank you.
Any other questions? Yes.
When we were trying to develop that simplified financial model on the bus terminal, we found the use of washroom, the revenue from the washroom was more higher than that from the bus fees. And probably, can you help us? How do we make the assumptions on the number of users of washrooms, especially the bus terminal?
Well, so you want to know how many people will use the washrooms, right? Yeah. So I will confess happily that I'm not an expert on this, but one of the things you could do is, and the data may already be out there, is you literally, remember Ned was talking about earlier in another session, we talked about difference between pre-feasibility and feasibility of a project. Pre-feasibility, a lot of times you can really just do at your desk. You can get the information, and you might even go into the field and do some things. If you're doing feasibility, and in this case, it's demand analysis, right? How many people are going to demand and need to use the washroom?
So the assumption from the pre-feasibility was 20% of the passengers.
Okay, right? And the way you can verify that or get some even kind of correlate the data is, for instance, you could go to an existing bus terminal. You have an idea of how many passengers are coming in, right? And literally, you would have somebody with a counter, a clicker, and might, like for 4 hours, click, 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 every time somebody goes into the washroom, just click. And you might do that across several bus stations. Now, I'm not, like I said, I'm not an expert on this, but it's statistical analysis, and you can then you can correlate or develop some kind of relationship between the number of passengers and those that use the washroom, right? But that's simply an example of, like Ned was saying, like in feasibility, Ned likes to use the example of waste to energy feasibility. And I know we have a project here, a waste to energy project. Well, at some point, you actually have to go in the field and touch and feel the garbage, the rubbish, and see what it is to make sure it's the right kind for your energy plant. Well, that's the same thing here. We got to go and actually verify it, right? Right.
Yeah, just one other thing that I would also say, again, as stakeholder management is pretty difficult, one of the things that you don't want to do in any service, if you start to charge too high a fee for using washrooms, human behavior is that's going to create there'll be a response. It might be an unwelcomed response, which is, that is something that we have to use, but you will just push the problem elsewhere. So one of the things that you need to think about. So, all right, thank you very much. Well done. Okay, we've had two very good presentations. Who would like to go next? Which group wants to go next? Yes, this is another market plot project now from Zanzibar.
Let me give you maybe a short explanation so that you can understand what we are doing in Zanzibar. Currently now we are having a 13 PPP. We put that 13 PPP in a bundle one, and we are expecting to have a pre-feasibility study, to have a full feasibility studies after completion of these 13 PFS. So from that 13 PFS, we for the purpose of our presentations, we choose a Chuini project, which is looked at West A Municipal Council. And from this, we are trying to come up with a model like this one. The total investment, cost is about 23 billions, or it can be 23.7, nearly to 24. And we divide it, and we say 30% is an equity, 70% is a debt. If you can see here, we've got 7.1 billions, and here we've got 16.5 is about maybe 17 approximately. From this, we had a lot of discussions on choosing the discount rate, and from this discussion we came up with 10%. When we come with this 10%, what we concentrate is on risk, and we find that the risk of the project is, it's not high. That's why we come with this, and we come with this 10 discount rate. And for the case of interest rate, we come with 12%, and this is almost, is a guessing, because clearly we couldn't realize maybe exactly interest rate. So from that, let me jump to the investment. In the case of, let me jump to the revenue, the source of revenue. In the case of revenue, because we are expecting to have a market, so there is stalls, shops, and these shops we categorize into 3 shops. One which is 120 square meters, and another one is 90 square meters, and the last one is 30 square meters. We put these 30 square meters, for those people who are maybe those who are doing small scales, maybe for the vendors. Because if you put maybe 120 square meters, this is is a large shop, it's a big shop. So they can't maybe afford it. And even this, it's come to the point that because this, the establishment of this shop, it is, the order from even the president and the RC and DC, they are comfortable with this project. So it got that support from the politician. So from after having this, explain about the revenue source. I think, let me be quick to the income statement. Here we get the net income of about 1.8. If we move from this, then we've got the cash flow here. We get from the cash flow, we get a 3.5. As we're proceeding, we get that 6.8. And if you go further, up to the 20 years of the project, here we might find that there is a 6.8. From this, we try to come up with the NPV, and we find that the NPV is 26.5 approximately, and we come with the project IRR. We find this is 25.6. Unfortunately, we couldn't manage to come with equity IRR because of the time. And you see the work is very tedious and having a lot of discussions. From this, here there is a bit a mistake that you might find, that is debt coverage service ratio we get is 2.6. That is a little bit larger. Maybe we have to come up with the discussions and having an advice to the consultant, the specialist here. Maybe can come with maybe a miscalculation and something else. For that, I say thank you.
What's something you think might happen over time with your operating costs with this project? Do you think they'll stay the same?
No, it's increasing.
Right? It should increase over time. Then why is that?
Yeah.
That's fine. You got a good model.
Yep.
Why should the cost increase? What will happen? You will have what over time?
If the cost is increasing over time for operating.
Right.
Yep.
Why would it increase?
Why it increase? Maybe it increases for the inflation. Yeah,
inflation,
like
right?
Yep.
So one of the things, as you continue to work on your model, you want to factor in inflation into the increase in costs, right?
Okay, yeah.
And the same goes, by the way, for your revenue. Over time, you probably won't be charging the same rents 15 years from now that you are now.
Yep.
Okay? So, but I think this is a good first crack at the model. You seem to capture a lot of the elements. Questions, comments? Ned, do you have any?
Sure. I guess one thing just on the assumptions, and the good thing about setting up a model, as we've seen with flexibility, is that you should be able to make changes to your assumptions. One of them I might just suggest we look at. You've got I don't know the full nature of the assets, but do you have a depreciation period of 10 years? Is that right?
Yeah.
And the term of the project itself is how long?
It's 20.
20?
Yeah.
Okay. I don't know if normally that would mean that you would expect you're going to have to replace all of the assets halfway through, right? So I don't know, again, and depreciation actually in reality, you don't just have one class of assets that all depreciate at the same rate over the life of a project. You might have some assets that last 20 years, some that might last a little shorter, but you might want to at least make sure usually the depreciation period should be pretty close to the expected life of the whole project.
Okay.
The other thing I might recommend here is that if you've got an interest rate on debt, and I don't know this, of 12%, a 10% discount rate would seem to me to be low. Again, coming up with discount rates is a very difficult subject, but usually you would expect an investor would have a discount rate above the cost of debt.
So this is for everyone. So depreciation is interesting. The depreciation helps us with our taxes, right? Because we have depreciation and we're going to levy a tax on the depreciated cash flow. But depreciation, and whether it's the market, whether it's a bus terminal, whether it's an energy project, when you have depreciation, as let's say you're the investor, are you actually making a depreciation payment? No, right? You're not making a depreciation. It's what we call an accounting term. It's good for you. It's good for your taxes. But one of the things for purposes of cash flow, it helps you realize the after-tax income. And this is what, let me take that back. It comes up with your taxable income and what you're going to levy the tax on. But the depreciation, because it's really an accounting device, it's almost an accounting fiction, for purposes of your cash flow, you add it back in, because that was not money you lost, okay? It's a good thing for you. So a lot of times what you would do in your cash flow, you would actually add the depreciation amount up here, would actually come back in, because you didn't actually pay anything out in depreciation. O&M, you paid out. You actually had to pay someone, okay? All right, any other questions or comments?
My concern is about the assumption that the operation and maintenance will be 20%. How did you come up with the assumption of 20% of the CapEx? And also, since this is the fact of things, when you're doing the assumption, it's not only the assumption from the imagination, but you really to reflect from the other books, let's say, for example, Financial Act and the other things. When you say the depreciation for building is maybe 5%, for the other things like land and what, it is maybe 12.5%. So when where did you come up with the figure of how can you use this percent instead of putting the numbers in that's what my concern is. Can you tell us how did you come with the 20% as a O&M also? How do you come with the percent of the depreciation?
Okay, for the case of 10% of O&M, here because we didn't have enough data for that, we tried to say in this income statement we say O&M, we have to put this 20% of the revenue that we are having. So from that we deduct, we calculate from that, and then we try to put that, because dividing the O&M maybe in every aspect as you have mentioned, because it makes us difficult, because this project is still in the concept and the preparation, so that we come with that. We would like maybe to come with those data, but staying here with coming with every aspect, I think which was a little bit tedious to us, and let's say for the purpose of that's why we come with that data. Yep.
Yes, maybe I ask on the debt service covering ratio. It is about 2.66, which is very high.
Yep.
Maybe what does it mean?
Do you ask me? Maybe this we have already explained. Maybe there is a bit technical, maybe a calculation that maybe we missed. Even ourselves, we get wondered on this data. That's why I ask here the facilitator maybe to try to ask, maybe to give us an ideas on how we can fix it. That's why, yeah. So you see? Yeah.
I would just add that, so you're right, 2.66 for debt service coverage ratio is higher than you normally would see, and it's proper to flag that. There's one of the things about when you become more familiar with these models and building them out is there'll be things that just kind of come out and you're like, wait, does that look right? And right, in our risk analysis, in our sensitivity analysis, we had the question, what if? The same thing in just checking the accuracy of our models. Sometimes things just don't look right, and with time, you kind of go back through your model and you examine those things. But I think it's a good start.
It is. And again, when you set up a model correctly like this, you can make changes to the input assumptions easily. One of the reasons why I might say that the debt service coverage ratio looks high, good of you to point that out. What is the term on this debt? Does anybody remember? 20 years. Is it 20 or 10? Yeah, what is the term on this debt, the assumption? I thought it might have been 20 years.
Go down to the loan.
Probably not realistic to have a project with a 20-year term where you're paying debt all the way to the very last day of the project.
It's 20 years for the debt.
Okay, if you spread it out, this is why it's very nice. If you can spread, if you have the luxury of spreading debt payment out that long, you're going to have a higher debt service coverage ratio. I wouldn't think that's quite realistic, probably, if it's a project with a 20-year term. Number one, probably the maximum that you'd want would be 15 years. Lenders would say, give us some room on the end, so there's some flexibility if we need to refinance. And then a second question is probably, can lenders actually lend for 15 years? You might find that in the local markets, they may be only able to lend for 5 years. In a project with a term of 20 years, you'd probably want to come up with, and you need debt financing if you need it. I would say you'd probably need at least a minimum of 10 years. Because otherwise, if you're trying to pay off that 70% debt over the first 5 years of a 20-year project, you're going to have really high revenue requirements for the first 5 years and then low ones later on. But that answers that question. All right, thank you very much. Well done. Okay, and who would like to go next? Our TAA.
Engineer Diana from TA, Manager Technical Services of Julius Nyerere. I would like to acknowledge my boss. The project location, it's just at Julius Nyerere, just adjacent to the new Terminal 2 building. The project is about the construction of airport hotel. It's a 4-star hotel. The purpose and the goal of the project is to provide the customers with the international standards accommodation facilities. As you all understand, currently we have all these big hotels aligned around this side here, which makes most of the potential passengers to drive all this way with the traffic jams and all those kind of things. And also, as part of the core business in airports, we have aeronautical revenues and non-aeronautical revenues. So we want also to get out of the box and to start collecting cash for the non-aeronautical revenues, which among the activities is like these projects. And the major stakeholders, we have the Ministry of Works, Transport and Communication, Ministry of Finance, LGAs, airport developers, passengers, general public, and so forth, utility providers, and so forth. And we tried also to cater what are the concerns of most of the stakeholders, like for the ministry, which we are reporting to, the Ministry of Works, Transport and Communication. They will be responsible for policy guidance and recommendation. Our commissioner there, Commissioner Mboya, will be responsible for approving the project. LGAs, they'll be for sensitization and all those kind of things. We have BRERA, TIC, the Tanzania Investments Commission, and so forth. We came to the question of the level of demand, and for our case, we found the demand is high because, as I said earlier, we have travelers, business people, tourists, airline companies with the crews coming all this side, and then they had to check out early for catching up with the check-in time and all those kind of things. And then we get into the capital investment cost, which it was 70 million. This is T shillings. And the contract period, the project term, it's 30 years. And we projected that the depreciation of the facility, which basically we took the building, it will be 2% annually, which is equivalent, like the total depreciation will be 50 years. So by the time we finish up the project, the 30 years, we'll have the residual life of 20 years. And then when it came to the financing availability, we took the 30-70, of which equity was 30, equivalent to 21 billion, and the loan was 49. Okay, loan period. And then these we just got from the other presentation from Abdi. We took the loan period of 30 years, and then when you come later to the model, we found like IRR and everything was okay, but the debt service ratio, it was high, and then I think this is the problem because we took the loan period to be 30 years. And the interest rate was 12%, and when we come to the operating and maintenance cost, we took, and this basically we took from the general operating cost for the terminals we have, and then it was ranging around 30%. And then for which 26% was the fixed ones, the wages, salaries, security, cleaning, electricity, and all those kind of things for the utilities. And the 4% was the variable cost for the promotions, changing of the facilities, like the kitchen facilities, laundry equipment, and all those kind of things. And then the last one was the taxes. There are other taxes which we considered the VAT and the corporate tax. And those other taxes like the land tax, property tax, because they are minute for the model, we took only 48% for the VAT and the corporate. And then when you come to the model, as I said earlier, the investment was 70 billion, and which equity was the 3%, and the debt was 70. And the interest rate, we took the current market rates of 12%. The debt term, this one, as I said initially, we took 30, but I think we'll have to change that. And the depreciation, as I said, we considered the 2% depreciation, which make like, after we finish the project, we'll have the residual life of 20 years, so basically it was 50 years. Project term 30, and as I said, we considered the taxes for the VAT and corporate. And when you come to the working, the revenue, we considered the major flow of revenue will come from the rooms, of which we have VIP rooms, executive rooms, and the normal rooms, which we are rounding up to 300. And average pricing, others were 400,000, 200, 300, so average pricing was 300,000, and we took the occupancy rate of 50%. I don't know, you can advise on that. And then from that, the revenue expected was, we took first per day, and then we multiplied, and all those blah, blah, and then we got 16 billion annually. And then we came to the meeting rooms, of which we considered to have 5 meeting rooms, with the average price of 5 million, and also occupancy rate, we considered 50%. And the revenue expected, it was annually 3.3 billion. We had also some shops and supermarkets and all that, and there are 4. And the annual expected revenue was 64.8 million. And then we had bar and restaurants, which were 6, and occupants rate, because we are expecting that they will be making some money, so occupants was 90%. They won't be moving out. And the revenue expected was 226.8. So the total revenue, when you accumulated that, it was 20 billion. So when I come back to the model, so this one was what we kept here. And then, as I said, initially we took the O&M, though in the initial working we said how do we split it out and all those kind of things. So when we improve, we'll keep the fixed and the variable ones separately. But when we're doing our working, we just took the 30%, and then we calculated the depreciation, which is the capex over the duration of 30 years, and then we get the value, and then we get the earning before income, interest and taxes, which was 11 billion, and then we calculated the interest, the fixing, the +4 and all those, that kind of things. And then we got the taxes, which I said we considered VAT and corporate tax, and then we get our net income. After that, we calculated the cash flow. We took the net cash flow, which we obtained from the income statement. We added back the depreciation, and then we got the PPMT, the principal. We subtracted the principal, and then we got the total cash flow, of which and this initially I didn't say that, and this up to the second year it was the constructing period, so that's why we start with the third year. That's why we start to accumulate the revenue. So when we calculate that, the IRR on equity, we got 17%, and EBITDA we got 14%, and then we obtained the interest, the debt service as per whatsoever, and then we got the value and the debt service coverage ratio. And I think this one is just Ned say here and Mr. Butarazi, it was high, and we think it's because we distributed the loan for the 30 years. So if we just get into realistic, as the way he advised most commercial banks, they won't want to have all those liabilities of lending money for 30 years, and I think we'll be on track on this. Thank you.
One question that I do have is that usually when projects like this are done, you rent out space on commercially very valuable sites, like at airports or container terminals or others. That part of one of the goals that the contracting authority has is receiving some form of revenue from it. And the options are oftentimes, well, you could have a fixed lease where the hotel operator gives you a fixed amount of money regardless of how their fortunes are. Another one is that you could have a variable amount that it's a fraction of your gross revenues, so it sort of shares the risk, or sometimes there are combinations of both. Does TAA have a goal in this case? Are you thinking of either a fixed say rental payment from your private partner, or a percent of revenue sharing, or what was your thinking on that? I don't know which one of you ladies would care to answer that.
So far, we have the concession agreement and all that. So in the part of the contract we have with the private part, we normally have the percentage. Yeah, okay. Yeah.
I will recommend, because she's smart on this, to present this model to the government team, which currently is preparing the pre-feasibility study, and we understand that the TAA have injected the engineering and the architect consultants to do the construction work and so forth. So once you have the realistic data, then you could improve the financial model. Yeah, so because we have to do this practically and use this knowledge for doing the real examples, real projects on ground. So thank you very much. I know the team is going to meet in Morogoro, so I recommend that you present this model and then you could have some inputs. Okay. This project is on the construction of the students' hostels at CBE campus, and we have a big gap, a big problem there, where we have about the students, the total students who in the hostel, the total students we are having is 8,000, but only 5% of them are accommodated in our facilities. So we are considering to have this facility that will accommodate at least 20% of the students' number. And to start with, in the year one, we expected to have 1,500 students, and the facility we are thinking of is going to have the capacity of 2,800 students, and we expect it to grow in 70%. In terms of capex, it is $12.47 million, and out of that, 70% is loan and 30% is equity. And we have other assumptions from the pre-feasibility study we have done. The interest rate is 15%. The loan term is 10 years, And we have a head count of 10 staff who are going to to work in the hostel. And we expect to increase their wage 10% in each year. And we have inflation of 4%. Maintenance expenses, we estimate to be 15% per year. Administration expenses, we have aggregated that to a total of 12,000. Income tax is 30%, and we expect to exempt this project from VAT. It is a very sensitive project where, you know, when you have students stay outside the campus, you have a lot, several, challenges, moral challenges, which impact the students' performance. So we have to exempt this on VAT payment. So this is the capacity growth, growing from 54% in the second year where the project is expected to start to 98% by the end of year 11. So you can see this is the growth of the students being accommodated in the hostel. And as regards the capital investment, so this is the capital schedule. You can see, okay, we have we consider the depreciation rate to be 5%. So the capex here is 12.47 million USD. So you can see this schedule started to depreciate in 5% per annum. Then to the book value at the end of the 11th year is 7.1 USD million, something like that. In terms of financing, this is the financing schedule. You can see the total debt service which the project is going to pay. We are going to pay is 16.7 million USD. And you can see, the total capital expenditure capex, as I said, is USD 12.47 million, in which the debt is 8.7, 8.7 USD million, and the equity is 20% of that, which is 3.7 million. So lastly is the income statement. You can see, as I said, in the year 2020, where the project is starting, we started with the student number, which is 1,500. As I said, growing up to 2,758. This is the 2029, 9th year. So that is 10 years there for operation. And you can see operating and maintenance expenses there. Total wage, okay, total labor total wage, which we are going to pay for the head count. We have other expenses, electricity. We have the administration, interest expense, and the other expenses listed there. So we have total operating and maintenance expenses. So we have a net present value of USD 12.9 million USD. And the internal rate of return is 17%. The debt service coverage ratio ranges from 1.76 to 1.99, at the 11th year. So this is the hypothetical example. I know we are learning. When we have real data, then this is going to change. Thank you very much.
One question I have is that I've seen, looking at other student hostel projects, that oftentimes the big challenge on these projects is affordability. I was just wondering if you were able to come up with an affordable assumed rate for each student to pay for hostel services. And were you able to compare that to sort of current rates?
Yeah, that is a good question, and I know they have done the demand survey, which they have established that the maximum of an average of 1 million T shillings, per annum, the students are able to afford, in 1 year. So what is important is the quality of the facility, The students would like to have more, affordable and the quality service facilities. So I think from the pre-feasibility study, they have established something like 1 million T shillings. That is why we have approximated that to be something like 700.
My name is Mhando from Kinondoni Municipal Council. With me is Mr. Albert, a procurement officer. I'm here to present a project of the redevelopment of Msasan fish market. Our project is quite different a little bit with the other markets with the following specification. One, the major objective is to have a state-of-art fish market, which automatically will cut about 1,000 fishermen on daily basis. And we have the stakeholders, which we identified them as follows: the Kinondoni Municipal Council, PPP node, the World Bank, the project company, fishermen, the little outlets, and the customers. Each of the stakeholder has its responsibility in one way or another. I think the rest you understand. The capital investment is about, is estimated to be 9.5 billion Tanzanian shillings. And also the financing availability being debt and equity, in which the equity is 30% and the debt is 70%. And the bank interest rate is 16. The operating and the maintenance cost is divided into the fixed cost and the variable cost, in which the fixed cost is about 375 million, and also the variable cost is estimated to be 533 million. Also, let us come to the financial model. I think during the introduction of the whole, let's say, clinic was to make us aware, not as an expert, but to be aware with how to undergo the financial model. To our case, we started by developing a profit and loss statement, and then we go to cash flow and the other sheets with different relevant information. Because we are trying to see if the pre-feasibility report was relevant with the project, we come to find that in some of the input, for example, the IRR, which the project IRR, according to the pre-feasibility report, was 20%, but in our case, we found that it was 17.7. But also, because we are trying to look upon the pre-feasibility report, we found that the loan repayment period was about 8 years, but according to the cash flow, it seemed that it cannot facilitate the payment of the loan. Thank you.
Anybody else have any questions? So one question I have is this is a project for the redevelopment of an existing market, yes. That's right? Okay. Was it easier, because this is redeveloping a current project, is it easier to estimate what the revenues will be because you can compare them to an existing project with some background information on, say, rental rates and revenue levels? Were you able to base the revenue projection on what the existing market is currently making?
No, it was not easy to our case, but we conducted a willing to pay survey, which provided that the traders were willing to pay. But I've said earlier that this project is quite different with the others because we're having the two things which we never practice in our market: the ice factory and the cold rooms, okay. Which is it's having at least 50% of the revenue.
Very good. All right. One other thing that I've just seen in projects like this, that oftentimes we begin with assumed levels about O&M costs, we'll use a benchmark of saying, well, it's 20% of the CapEx. But actually, each marketplace is going to be different, and this is what you need to do in a feasibility study. In my experience, certain markets that are, say, for fish products or even ones where their slaughtering might be carried out of poultry or others, you may have greater costs when it comes to waste collection and cleaning than you might have in other markets. So this is why when we look at feasibility studies, you really want to itemize costs and sort of know, well, how much does it cost to actually clean, remove wastes and clean for specific products. But this just shows you, again, every project is unique. A marketplace in one area is not going to be the same as one in another area. So now you're better prepared to ask these detailed questions. Thank you very much. Well done. Okay, we have a couple more to go. Who would like to go next?
My name is Abdallah Mvungi. I'm from Arusha City Council, accompanied with Emmanuel Mhauka. So we are having a project of developing a power plant in Arusha City Council at Muriet landfill. And the sectors I've written is from solid waste management, and the project is disposal of municipal solid waste and converting it into energy. We are going to change waste into energy, power. The stakeholders, TANESCO, communities, political leaders, MOF, TAMISEMI, EWURA, waste collectors, and the general interest and concern is that Arusha City want to increase the own source of revenue, but also to increase the lifespan of the landfill. The estimated demand, the power plant, we are going to expect it to utilize 20 megawatt per day. And the estimated cost, investment cost is 200 billion. Estimated operation cost and maintenance is 10 billion. And then tax is VAT is 18 and 30 for corporate tax. This project is at the initial stage. We have finished to develop a concept note, still yet pre-visibility and visibility study, and then I try to put into a model so we can see if it work out, because we are going to cooperate with a certain company so that we can share. Then you can see there is no debt. I've put it there is equity, so we expect to have some grant from China government. So as I've explained, you can see there the equity is explained. The investment cost or the capital investment is 200 billion, which means 100 equity, no debt. And then you can find, because no debt, there is no interest rate is 0. The discount rate we have put 12%. The revenue we are expecting to get from this power station is, we are expecting the revenue from selling electricity to TANESCO, and we are expecting to produce, this power plant will produce 20 megabytes, which is equal to 20,000 kilowatt. And the price, which we have talked to TANESCO, which they are ready to procure for 1 kilowatt per hour is T shillings 263. So when you compute per hour, we got 5,260,000, and then per day we got 126 million, and then per year we got per year 46 billion, and then we try to compute with this utilization factor, that sometimes there's other days the plant cannot work, your service, etc., etc., etc. And then we have bricks, also revenue from bricks. We estimate it to have those ashes, then we can construct bricks, and then we expect it to construct 10,000 per day. And then the price is 600 per each brick, and then we expect to have per year 1.8 billion. So you can see here we have put the revenue. Of course, this model, as I've said, that is is a feasibility study not yet conducted, so it's just a tentative model for the purpose of running and getting ideas, views, etc. Revenue, then we expect to have 1.02 billion. As you can see here, we just approximate to have a fixed O&M 5%, and then you can see there. We decided to put the variable. Of course, yes, there is a challenge of this variable, and I was having the advice that such as those fuels, etc. But we didn't consider, but I think we can include it later. So, but here for this we put a variable O&M. We put 0. Corporate tax we put 30%, and then you can find that you can see now our cash flow. And we can, when we compute the IRR on equity, we got 7.5. And then MIRR, we got 3.4. The project IRR also is the same. You can see there because there's no debt, so the same as on equity is 7.5%. And then you can find DSCR, there is is 0 because there is no debt. And the NPV, when we got T-Sharing's 146.
All right. One comment I have, having worked on other similar either waste processing or waste to energy plants, is that normally we say that under a PPP there's an idea of a single purpose project company. And with waste to energy, it can start to get a little bit more complicated because you can be getting revenues from accepting solid waste. So for every ton of solid waste, there's revenues there. There can be revenues, as you've seen, from the sale of electricity. There can be revenues from selling steam. There could be revenues from, you've even identified bricks or briquettes in this case. And one of the things that starts to get complicated is you've got many stakeholders to manage, some with their own standards. So what happens if the supply of municipal waste into the incinerator does not really allow for a reliable baseload generator? Meaning that, does that mean that Tanesco is going to have to deal with a generator who perhaps they turn on, they turn off, or maybe they're not reliable 100% of the time? I've also seen in projects where you may take the waste product, something like compost or something like some of the others, and say we want to reuse it for another environmental purpose. Well, you have to be willing to then say, okay, we'll have another stakeholder at the table. It may be the Ministry of Environment, it may be some other stakeholder responsible for this. They're going to have their own standards and their own requirements. And this is why we say managing the stakeholders is the more difficult challenge in PPPs. So just keep that in mind. I guess the other question that I had here is, does anybody know why, if we scroll up even a little bit, why is the IRR on equity looking relatively low? Did anybody pick that up in this model? Why is it that the IRR on equity was 7.5%? That's even below what an interest rate would be. Again, with a model, you can make assumptions. Are they using any of the benefits of leverage here? The benefits of other people's money? Are they? No, it's an all equity deal. So this shows, and again, as you'd expect, the IRR on equity is the same as the IRR on the project, right? Yes. And you'll find that then as you finance more of a project using lower interest rate debt from other people, what's going to happen to your IRR on equity? It should increase, right? Yeah. Okay, great. Thank you very much.
My name is Beata from Ilala Municipal Council, and project is Buguruni Market. which located at Buguruni Ward in Ilala Municipal Council. Our project is brownfield because has already activities is undertaken there. There is a traders who make their business there, so it's brown. And during the construction, the traders will be located at another place which is near to Buguruni Market. Second is the overall objective or purpose of this project is to develop organized market which have enough space to each traders in order to reduce the congestion which are there and provide better facilities to the traders and consumers. Third, our stakeholders is traders, customers, truck driver, Ilala Municipal Council, PPP Note, project company, World Bank, and financial institutions. The following are the description of each stakeholders. Traders, their interest is to have a modern trading space. Traders need to access the quality services such as water, toilet, and electricity. Interest of traders is to make high profit due to increase of number of customers, due to the good quality service delivered there. Second is customer. Interest of customer is to access quality and hygiene product and service, to access related service like banks, toilets, and to have enough parking space, which in current situation there is no such services in Buguruni Market. Interest of Ilala Municipal Council is to provide better and quality services to the community. Also increase revenue collection, reduce congestion to the traders and the customers, and reduce communicable disease. 5, estimates of the level of demand of the project. Currently we have 3,300 traders which are available there. So most of them, 100% need the modern market. So all of them, they have a demand of having that modern market. Estimate of the capital investment. We have used USD as a terms of money. The estimate of the project is 5.6 million USD dollar, include VAT. Because our building, we have 3 floors, include ground floor, means G+2. Depreciation, according to the Finance Act, is 5% of the market building. Other is our financial analysis. The project is financial viable and is expected to attract interest of private developers because we have 16% of interests of long-term loan, principal payment period of 2 years, repayment period of 8 years, equity 30% of the project costs, and 70% of debt. Finance availability, it is from fee from user charge, which are in small stalls. We have charge 5,500 per day, and large store is 2,500 per day. And the other services which are related, such as toilets, parking, advertisement, and others will be charged according to the time of consumer safety. Estimated of the operation and maintenance cost, we have estimated to have 53,071 USD dollar will be used as an operation and maintenance cost, which include wages from workers, waste disposal, electricity charge, and a clean and security and cleanings. Taxes that private could be needed to pay is 8% of capital invested. We have tried to calculate the model, but it's not good. We try with our level best, and this is how you see is our model. Result of the model, project is viable because we have IRR of 20.8%. Thank you.
Here are some takeaways from this module. In this module, we learned that the financial model is not a static document, but rather a dynamic tool that you can use to examine the feasibility of a public-private partnership project by applying sensitivity analysis techniques.
I'd like to provide you with some additional takeaway points from today's module on PPP financial modeling techniques and sensitivity analysis and graphing. The first is that for PPP models to be effective, they need to be, number one, they need to be clear and easy to understand. So make sure your consultants show their work and they're easy to follow what they're doing. Secondly, they need to be robust, which means they need to offer clear, discrete results that you can make practical decisions on. And third, they do need to be flexible. You should be able to make changes to input variables and see what the results are. Second main point I want to make is that we've covered today not only sensitivity analysis, which is making a change to one input variable and seeing how the rest of your model performs, but there's also scenario analysis, in which we make changes to a range of variables, and we'll have different scenarios that we compare, such as a pessimistic scenario, base case scenario, and an optimistic scenario. Lastly, I want to point out that if you're ever responsible for presenting the results of a financial model to a senior decision maker who may not have a financial background, presenting them in the form of a well-prepared graph is a very easy way for anybody with a financial or non-financial background to understand a project and to make decisions on it. We'd like to thank you for watching this fifth and final module in this workshop on PPP financial modeling. We hope this has given you the tools, the techniques, and some of the insight that you'll need to oversee the process of PPP financial analysis in the future. And we'd like to wish you the best of luck in the future. Thank you.